Welcome back to another episode of 5 Minute DD. Today we're talking about USOI, the ETN that pays a 40% dividend yield. Is it legitimate? I'm going to get into all of that. For those that are new to my channel, this is a segment I've been doing where I take a couple hours. This took me forever to make. This took me multiple hours, but I jump in and do a bunch of research on a stock, an ETF, an ETN, and I talk about what I like about it and what I want to know before I buy it. Full transparency, I already own 3 shares of this covered call ETN that I bought about 4 or 5 months ago. So this is the Credit Suisse X-Links Crude Oil Shares Covered Call ETN. 40% dividend is actually about a 42% dividend, which is really impressive. But let's look at the chart. So it's down about 27% the past 6 months. The main reason with that, the market's been doing terribly, but this is a covered call, like I said, and it does covered calls on the USO, which is the United States Oil ETF, which has been dipping the past 6 months as well. So it shows that it does track that a little bit. The negative side of that is when, oil prices skyrocket, you're still only making mostly your dividend income. The price appreciation on this does not follow nearly as well. Same thing with all ETFs for those that don't know that. So if you're buying this expecting it to go to $100 to $200, it's extremely unlikely that happens within the short to mid term. So looking next at their dividend history, they've paid a dividend since 2017. They do pay monthly dividends, which I love. I'm going to be adding this to my 1K dividend account challenge where I'm putting $100 into 10 of the highest dividend yielding stocks, but also kind of my favorite, a little bit riskier. And that is on my YouTube channel if you guys want to check that out. So this one will be added to that, and it does have a nice history paying since 2017. A lot of the current ETFs that are popular, ticker JEPI, RYLD, have only been paying for like a year and a half to 2 years. So a 5-year history isn't great, but it's not terrible, kind of right in the middle. The last 2 dividends were $1.80 and $2.60. Now, this was why it took me so long to do this. Their ETNs are kind of frowned upon depending on who you talk to. They're a little bit more liquid than ETFs, and so it's higher risk as well as I'll talk more about that in the con section, but there's just more to them than ETFs. They are higher risk, so take that with a grain of salt. The reason it was hard to calculate this and the dividend yield is because they recently just did a reverse stock split. They did a 20-for-1 reverse stock split, meaning 20 shares became 1. I owned 60 shares before. I own 3 now. And so that causes a bunch of issues. The chart does show that. The charts do add that in, and so that's why it looks like this. It used to be like $400 or $500 a share even before this. So that is shown in the chart, but the dividend payout history does not show that. So when you're looking and saying, why does it pay a 40% dividend yield? Paying out 17 cents when it's $80 doesn't make any sense. That is why. So those dividends do come out monthly to being multiple dollars, which is really impressive. And I love it. I tracked my old dividends when I did buy this, and I've been paid 2 dividends since the split. I bought just before the split, like I said, or reverse split. And so that does make a big difference in those dividend payouts, but it has been doing pretty well. We talked about the covered call options on USO. That does make it a little bit of a negative if you're bear or bull on oil. I'm kind of midline on oil. I think we're going to continue to see it rise. It may fall more short term, but I think long term it will rise. And then we talked about that reverse split, which is really important when you're doing research into one of these companies. All that research that you can, because it took me so long to figure out exactly when it split, because it's done multiple splits. And the main pro, why I put the reverse split in the pro, most of the time you wouldn't think of reverse split as a pro. Penny stocks do it to stay listed, is that Credit Suisse, I believe is how I said it was pronounced. They did this because it enables larger funds to buy, because a lot of funds will not buy stocks that are below $10, below $5, because they can be more volatile and they're considered penny stocks depending on how you define that term. So they shrunk it. They grew the price so that more funds would be apt to buy into this, which I like, and it gives you more capital overall, more volume in the stock. So I think it was a good decision. It didn't hurt shareholders much at all because you're not focused on price appreciation. Typically, a reverse split will hurt you if price appreciation is what you're going for. But again, we're going for dividends, so that makes sense. Now we're going to jump into the cons. I'm supposed to keep this under 5 minutes. Let's see if I can do it. Exchange traded note volatility. So like I said earlier, extremely volatile. And the reasoning is because there's no real set point for dividends. They will pay a dividend, but you never know how much it's actually going to be, and it does bounce all over the place. If you're looking for consistent income, this is not what you want. If you're looking for income where you can just purchase it and not really care and just use that money in a fund or have it drip back into USOI or other dividends, perfect. This is what you're looking for. Not financial advice, but that's what I would use this kind of ETN for. And then, like I said, the liquidity makes it a little more dangerous. If it was to go bankrupt, if they were to dissolve the fund, you wouldn't necessarily lose all your money, but there's a chance. It's extremely technical, and I'm not going to pretend like I understand all of it. Just know that it is higher risk for those, and do more research on it. I can't get into all the details in this video because it will not be 5 minutes. And then a 0.85 expense ratio. Higher than average. Most ETFs are about 0.7, so it's a little bit up their expense ratio, but it pays a 40% dividend yield, so you're going to cover that plus some compared to JEPI and XYLD and RYLD. So people complain about the expense ratio, and I get it. You don't want to pay more money, but I mean, look at what it's returning. It's pretty wild. So again, key takeaways from this video: this is not a price appreciation fund. It is a dividend paying fund. If you're looking for dividends, it is a risky option, but it is an option. I do own some of it. I will be buying more because I do like it and I do like the monthly income from it. Lastly, this is not financial advice. Thank you guys so much for watching this video. Like, subscribe, comment. This took me forever. Please help me out. I appreciate all of you guys for watching. 33 subscribers, slowly growing. We've gained 10 in the last month alone. And all my socials have been growing. I'll link everything down below. Thank you guys for watching. I'll see you in the next one.